Hey there, folks. We're diving into the exciting world of investing. And trust me, you don't need to be a Wall Street wizard to make it big. Today, we're talking ETFs, or exchange traded funds, your secret weapon to building wealth. Think of ETFs like a basket of stocks, bonds, or other assets, all neatly packaged into one easy to trade unit. They're like the all-star team of the investing world, offering instant diversification and the potential for significant growth. Now, why should you care about ETFs? Well, they're incredibly user-friendly, especially for beginners. You don't need to be a stock-picking guru or spend hours researching individual companies. ETFs do the heavy lifting for you, spreading your investment across a range of assets. This means you're not putting all your eggs in one basket, which is crucial for managing risk. ETFs are also super flexible. You can buy and sell them on major stock exchanges, just like individual stocks, giving you the freedom to manage your investments on your terms. Plus, they typically come with lower expense ratios compared to traditional mutual funds, meaning you keep more of your hard-earned profits. So whether you're just starting or a seasoned investor, ETFs deserve a spot on your radar. One of the most beautiful things about investing, especially in growth-oriented ETFs, is the power of compounding. It's like magic, but instead of pulling a rabbit out of a hat, you're growing your wealth exponentially over time. Here's the deal. When you reinvest your earnings, those earnings generate their own earnings. It's a snowball effect that can turn small, consistent investments into a substantial nest egg over the long haul. Let's say you invest just $200 a month in a growth ETF that, on average, returns 7% annually. Seems modest, right? But hold on, because after 30 years, you'd have over $250,000. That's the magic of compounding in action. The earlier you start, the more time your money has to work its magic. Even if you're starting small, don't underestimate the power of consistency. Think of it like building a muscle. The more you work at it, the stronger it gets. Every dollar you invest is like another rep, bringing you closer to your financial goals. Remember, it's not about timing the market perfectly, but rather about time in the market. So start early, stay consistent, and watch your investments flourish. Investing isn't a get-rich-quick scheme. It's a marathon, not a sprint. And there will be ups and downs in the market. That's inevitable. But the key to long-term success is to stay the course, even when things get bumpy. Remember, short-term market fluctuations are just noise. What matters is the overall upward trajectory of your investments over the long haul. When the market takes a dip, it can be tempting to panic and sell your investments, but resist that urge. Selling low locks in your losses and prevents you from participating in the eventual rebound. Instead, view market downturns as opportunities to buy more of your favorite ETFs at a discount. Think of it like a sale at your favorite store. You're getting more bang for your buck. The key is to develop a solid investment plan and stick to it, no matter what the market throws your way. Ignore the short-term noise and focus on your long-term goals. Remember, consistency is key when it comes to investing. By staying disciplined and riding out the market's ups and downs, you'll be well positioned to achieve your financial aspirations. Now that you're pumped about ETFs, let's talk about how to pick the right ones for your portfolio. Don't worry, it's not as daunting as it sounds. First things first, identify your investment goals. Are you looking for long-term growth, income generation, or a bit of both? Your goals will determine the types of ETFs that align with your investment strategy. Next, consider your risk tolerance. Are you comfortable with a bit of volatility, or do you prefer a smoother ride? Growth ETFs, for instance, tend to be more volatile but offer higher potential returns, while bond ETFs are generally less risky but may provide more modest growth. There are also ETFs that focus on specific sectors like technology, healthcare, or renewable energy, allowing you to tailor your investments to your interests. When evaluating ETFs, pay attention to factors like expense ratios, trading volume, and the underlying holdings. Lower expense ratios mean more of your money is working for you, while higher trading volume indicates greater liquidity, making it easier to buy and sell your shares. And of course, understanding the underlying assets held by the ETF is crucial to ensure it aligns with your investment strategy. Section 5, don't bet the farm. Diversification for steady growth. One of the golden rules of investing is diversification. Don't put all your eggs in one basket. The same principle applies to ETFs. While ETFs offer instant diversification within a specific asset class or sector, it's still essential to diversify across different asset classes. Think of it like building a well-rounded sports team. You wouldn't want a team consisting solely of quarterbacks, would you? You need a mix of players with different skills and strengths to succeed. Similarly, a well-diversified portfolio should include a mix of ETFs spanning different asset classes such as stocks, bonds, real estate, and commodities. By spreading your investments across different asset classes, you reduce the impact of any single investment on your overall portfolio. When one asset class is down, another may be up, providing a buffer against significant losses. Diversification is your secret weapon to achieving steady growth and weathering market storms. Section 6, ETFs versus mutual funds. Picking the right weapon for your arsenal. Now, you might be wondering, how do ETFs differ from mutual funds and which one is right for me? Both ETFs and mutual funds offer diversification and professional management, but they have key differences that set them apart. ETFs, as we discussed, trade on stock exchanges like individual stocks. This means you can buy and sell them throughout the trading day, and their prices fluctuate in real time. Mutual funds, on the other hand, are priced only once a day at the end of the trading day. This means you won't know the exact price you're buying or selling at until after the fact. ETFs generally have lower expense ratios compared to mutual funds, making them a more cost-effective option for many investors. Additionally, ETFs tend to be more tax efficient than mutual funds because they generate fewer taxable events. However, mutual funds offer more flexibility in terms of investment minimums, which can be beneficial for investors just starting. Ultimately, the choice between ETFs and mutual funds depends on your individual needs and preferences. ETFs offer real-time pricing, lower costs, and tax efficiency, while mutual funds provide more flexibility in investment minimums. Carefully consider your investment goals, risk tolerance, and investment timeline to determine the best fit for you. Section 7, riding the market, roller coaster, staying calm amidst volatility, Investing in the stock market is like riding a roller coaster. There will be exhilarating highs and stomach-churning lows. The key is to buckle up, enjoy the ride, and most importantly, stay calm amidst the volatility. Remember, short-term market fluctuations are a natural part of the investing journey. When the market takes a dive, it can be unnerving, but it's important to remember that market corrections and bear markets are a normal part of the economic cycle. They present opportunities to buy quality investments at discounted prices. Panic selling, on the other hand, can decimate your portfolio and prevent you from participating in the eventual recovery. Instead of reacting emotionally to market swings, focus on your long-term investment plan. Review your portfolio regularly to ensure it still aligns with your goals, but avoid making rash decisions based on short-term market movements. Remember, time in the market is more important than timing the market. Section 8, time is money. The early bird catches the growth spurt. When it comes to investing, time is your greatest ally. The earlier you start, the more time your money has to grow and compound, potentially turning small contributions into a substantial nest egg over time. Even if you can only invest a small amount initially, the power of compounding can work wonders over the long term. Consider this. If you invest $10,000 at a 7% annual return, after 30 years, your investment will have grown to over $76,000. However, if you had started investing that same amount 10 years earlier, your investment would be worth over $196,000. That's the difference a decade can make. The lesson here is clear. Don't wait to start investing. Time is of the essence. And the sooner you begin, the more you can harness the power of compounding to grow your wealth. Even if you're starting small, remember that consistency is key. Every contribution, no matter how small, brings you one step closer to your financial goals. Section 9, unlocking your financial future. The power of long-term investing. Investing isn't just about making money. It's about securing your financial future and achieving your dreams. Whether it's retiring comfortably, buying your dream home, or funding your children's education, long-term investing empowers you to turn your aspirations into reality. By investing consistently in growth-oriented assets like ETFs, you're essentially planting seeds for your future. These seeds, nurtured by the power of compounding, have the potential to blossom into a bountiful harvest, providing you with financial security and freedom down the road. Long-term investing requires patience, discipline, and a long-term perspective. It's not about getting rich quick, but rather about steadily building wealth over time. By staying focused on your goals, writing out market fluctuations, and remaining committed to your investment strategy, you can unlock a brighter financial future for yourself and your loved ones. Section 10, take charge. Your journey to financial freedom starts today. So there you have it. The power of ETFs and the transformative potential of long-term investing. Remember, you don't need to be a financial expert to get started. With a little knowledge, discipline, and a commitment to your financial well-being, you can unlock a world of opportunities. Start by setting clear financial goals, determining your risk tolerance, and exploring the world of ETFs. There's an ETF out there for everyone, regardless of your investment style or financial situation. Remember, diversification is key So spread your investments across different asset classes to mitigate risk and enhance returns. Most importantly, take action. Don't let procrastination or fear hold you back from securing your financial future. The first step is always the hardest, but once you take it, you'll be well on your way to achieving your financial dreams. Remember, the journey of 1,000 miles begins with a single step. Take charge of your financial destiny today and embrace the exciting world of investing.